Ramin, I guess I lost you. Yeah, well, Ramin has been going around bullying Home Depot employees and taking their aprons because everybody thinks he works for Home Depot instead of loanDepot. Well, I guess Ramin's going to be out for a little while, and I get to talk all on my own. And I really don't like talking, so we'll see how this goes, right? So today, our topic for today was going to be about the current effect that the mortgage rates are having on the housing market. Okay, because we are seeing the housing market, the inventories like slow down. Like inventory was starting to build up, and then all of a sudden, as the rates dropped, the offers, more buyers got off the fence, and they just started making more offers, and yeah, it's causing inventory to slow down. Now, this very important. This is very specific to Santa Clara County. Okay, there's other. I mean, if you're in Ohio, it's probably not the case, but very, very specific to Santa Clara County. Inventory is down, and it's causing like it has a true effect. Now in let me see, in what was it, August? We're in August, right? Yeah, in August we really enjoyed the lower rates, right? It was wonderful. We saw rates into the fives, which was amazing, mid fives for VA and FHA, some FHA, and then mid sixes to low sixes on conventional. Now, that was great. Refinances were up, and this was because of the higher unemployment. Now, there's a bunch of mixed data, right? Higher unemployment is saying or indicating that the mortgage or the inflation is down, under control, and boom, you just um, it prompts the Federal Reserve to lower the interest rate. Well, lower interest rate causes the price of the homes to go up because there's more people buying, right? There's going to be more buyers that jump off the fence. So we got to enjoy all of that. It was great. And the question is, how long will it last, right? Is it going to go through September, where typically September tends to the mortgage rates tend to go up historically. If you look back at it every year, September is yeah, one of those months where the rates go up. So what's going to happen if the Federal Reserve lowers the mortgage or the Fed funds rate? They say, "Oh, we're going to do the cut." However, the mortgage rates still continue to go up, right? Does that make any sense? Probably not. But I want to add that, remember, mortgage rates are not governed or controlled by the Federal Reserve. The Federal Reserve controls the rate that the banks lend to each other amongst themselves, the overnight rate. So it does directly influence what the mortgage interest rate is, but it does not control it directly. So yeah, that's what we were on here. That's what we're going to talk about as soon as Ramin comes on. But he's out there busy
Speak of the
bullying
devil.
the Home Depot employees. Oh, there you are. Welcome back.
Thank you, man.
So
God bless Comcast, brother. God bless Comcast. I am actually so. I actually call these guys every time my internet goes down here. I call them. Hey, we have a business account, and they're supposed to keep us up all the time. But regardless, I'm going to switch over to T-Mobile, man. I think they got a faster downloads, faster uploads, and I'm so done with Comcast. Although that's one of the stocks that Warren Buffett did invest in right now. He invested in Kraft,
uh
Comcast, and I forgot the other company name again. So three new companies that he's really interested in these days. So yeah, but I'm
well,
not a big fan of
uh,
Comcast.
well, welcome back,
Thank
and
you,
I'm
sir.
glad you're not punking the Home Depot employees.
No, not at all.
Please don't do that again.
Okay.
Hey, so Ramin, while you were off busy punking Home Depot employees, I kind of covered what we're going to talk about today, right?
Okay.
Which is August, how we enjoyed the lower rates in August,
Yeah.
a little bit on the higher unemployment, and, and that caused, the Federal Reserve to think about and consider September Fed cut or rate cut. And with that lower rate, more offers on each house, which equals higher prices, more bidding wars, et cetera, et cetera. Very specific to Santa Clara County, because I
Santa
know
Clara
there's,
County.
yeah, I know
Absolutely.
there's going to be listeners that they're going to say, oh, wait, what? That's not happening. Well, at a national level, probably not, but we're very specific to Santa Clara County. And that's where I'm at. And Ramin, tell me about August. What'd you see in August?
Well, it's going to be I think so that people are looking for lower rates in September. I'm already doing a couple, I think three or four refinances. I forget. Anyway, three or four refinances right now. I think there's four actually. Refinances right now. So I think that probably I would have waited slightly for the September rate cut to refinance, but it was a good opportunity, and I think these guys got a good rate. Regardless, I think that the Fed is talking about a 0.5% drop in rates at this point. It's going to really depend on the BLS jobs number. And if you're not familiar with BLS, it's the Bureau of Labor Statistics. And that is what the government uses to see how people are employed or unemployed. But the problem with BLS, Lou, is that they do a survey of about 40,000, I'm sorry, 60,000 people, businesses and people, and they say, hey, what's going on? Since COVID, that response rate has come down to 40%. So they're not getting all the people's responses back, which is kind of crazy. So they have to impute that data from somewhere. So what they do is they say, hey, we have a birth death model for businesses. These businesses are becoming new, coming up, birthed. These businesses are dying. They closed shop. And they had 5 employees. This new business has 6 employees. So we created one new job, essentially. All right. So that's how they kind of impute that data. But the
Right.
problem is this imputed data is not realistic. And this has been something that people are complaining about all the time. Because right now, I think this week we get, is it this week or next week? We get the new BLS report. Actually, we get it every week, but we get the final BLS numbers at the end of the month. But every month they revise the numbers. So this month we're going to get revisions for July and June. All right. So even though we said we have 265,000 new jobs being created, they're going to come back and say, oops, we goofed. And we're going to revise that number down by 87,000 jobs or something like that. That's what it was last month. So they revised last month's numbers from 257 down 87,000. So we didn't have 225,000 jobs created. We had 150,000 jobs created. And they're going to come back in August and revise the June numbers again. So those June numbers are going to come by another 25,000 jobs down. And this is really relevant because I see my friends who are in the tech industry here. I had one of my friends was laid off for 7 months. He had a hard time getting back in because people are just simply not hiring. And all my other friends who are at Facebook or who are at Amazon or at Apple's okay. Actually, Apple hasn't been firing that many people or laying them off. But Amazon, what do you call it? Facebook and well, Meta is Facebook, and gosh darn it, Microsoft. Those guys are laying off people. So if you're losing your job, you're going to be afraid to buy a new house. So this is going to be a big part of the rate cut incentive coming down in September. If the BLS jobs reports come back positive and say we've got 300,000 new jobs created, well, that's going to be an issue. And they're going to say, okay, we're not going to lower the rates by that much because the economy is flying high. We're doing well.
Mhm.
But if BLS comes back low and revisions come back low, then that's going to be an issue at that point. And I think that I'm estimating a 0.5 point rate cut from what I've been seeing through all the things I listen to and read about. I think it's going to be a 0.5 point rate cut at this point. I think there's 14 members are saying about a 0.5 point at this point. 14 members of the Fed, the voting members. All right. And also another problem I have with the Fed, Lou, is that they're lawyers and they're not accountants or
Economist.
economists, right? You can see the San Francisco Fed chairwoman. Her previous life was running her dad's bank in California, which is a job she probably got because she's his daughter. She is an attorney by nature, and she is now the Fed chairman in San Francisco. So what decisions can she really make as an attorney that she is so knowledgeable about the economy? I don't think her knowledge stands up. And again, you can see this across the board what's happening. The Fed is a central bank and it's trying to control the income, the economy by saying, I'm going to flip this lever, I'm going to lower rates, or I'm going to increase rates so that we slow the economy down, and hopefully we'll get it right and land softly. But that's not an exact science, right? It's an art.
Softly.
Yeah, right.
Right. So let's just say that the rates do drop. Let's just say 1%.
Okay,
Fed cuts 1% overnight.
sure.
Award rate is now, what is that right now? 4 point or 5.5 or whatever. Let's
Let's
just
just
say
say
it drops to 4.5.
okay,
1% rate cut, 100 basis points.
right.
Yeah. How's that going to affect the mortgage interest rates? Will it? Because we all know that the Federal Reserve, Fed's fund rate, influences indirectly the mortgage interest rates, right?
Correct.
So what happens if, the Feds drop their Fed funds rate, but
Well,
the
the
mortgage
Fed
rates go up?
funds rate is the overnight lending rate. It's what Bank of
Right.
America uses to borrow money from Wells Fargo because it's got some deposits coming in and say, hey, they're going to be in tomorrow. They're going to get wired in. We need some extra money tonight to make our funds close. So they borrow from Bank of America at that Fed funds rate, or they borrow from CIBC or from Silicon Valley or whatever it is, whatever bank. It's interbank borrowing rate. They borrow from the Fed to make up their reserves so they can send out more money. So that's just the Fed funds rate. What really I like to look at, two things. When you guys, for the non-technical people in here, when you get a mortgage, when you sign up for a mortgage, you're put into a bucket, and that bucket is a bunch of files, 1,000 files at a time. They're called mortgage-backed securities or collateralized debt. Essentially, this is what we had, collateral-backed obligations, CBOs. This is what the movie The Big Short was about, right? So we're packaged into these bunch of folders and files where we're saying, hey, I got a bunch of guys who have a 720 FICO. They make $220,000. Their DTIs are about, debt to income ratios are, 40%, and they've bought $1 million houses, and we got, 20% loan to value. So they've only borrowed, 20% or 80% on the house. So I'm going to sell you a block of these files that I have. I have a few of those files right here, actually, Lou. Here's one of my collateralized debt obligation files right here. I'm going to sell
Right.
it to you
Well,
for
they're basically a bunch of IOUs, right?
IOUs.
That
I'm going to sell it
promissory
to you.
note that the buyer or the borrower signs. I promise
Correct.
to pay at this rate. So you
Correct.
bundle 100 of them or 500 or 1,000 of them.
1,000 of
And
them,
then
and I sell them to you as a package. I say, hey, Lou, these are good stuff. These are AAA rated stuff. Okay.
Mhm.
I got some bad files too. I got some 540 FICOs. That's these guys right here. I'm going to sell you these 540 FICOs. They're all in Santa Clara County, and they're only for $720,000. So they're all Fannie Mae products, blah, 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 blah. So you say, hey, that's pretty good, man. I like the, lower FICO scores because these are going to default on their homes. I'm going to try to foreclose on them or whatever. These are C-rated bonds or whatever they are, C-rated packages. So again, go watch The Big Short and you can just see what's happening. But we have these CBOs, collateral-backed obligations, and they are being sold as MBSs or mortgage-backed securities, and you're
to
putting them in your
who?
401k to
To
all kinds of people, to hedge fund guys, to the general market. So these
who's selling
MBS,
them?
everybody, we sell them, the banks sell them, everybody sells them to investors. So these are investors selling to investors. All right. And these are called MBSs. MBSs, you can track that on the internet. And I think that's one of the things I like to track. But my favorite measure of interest rates is the 10-year treasury. I think most people are going to
Right.
be in the same boat, right? So if you want to track MBS, it's called UMBS. And just check it out just type in UMBS in Google. And right now, UMBS is at 100.61. It's up 4 basis points today as of 3 o'clock.
And
So it's good
that's pretty
stuff.
good,
Yeah, not bad. And
right?
then
That's pretty good. So what I got a question. I'm
hit
not
me.
I know you're not an economist, so it's okay if you don't understand or know this, but what role does Fannie and Freddie play in all of this then? Are they the ones that securitize and package those MBS? Because from my understanding is I borrow, $500,000, I sign an IOU, those get all pooled and then sold on the secondary market, which is Fannie Freddie. We already know where they're going. Fannie Freddie says, all right, here's the $500,000 for this loan plus, I don't know, $25,000 premium or whatever that case it may be. We pay as a lender, we pay our warehouse line off and profit that other 25, and we're ready to lend again. I mean, in the simplest terms, that's my understanding of how this cycle works.
It's a
Then,
government-backed entity. So Fannie is government-backed, and they buy mortgages from lenders to increase affordable lending and provide access to homeownership. So it's basically the government is backing this loan. It's saying, "Hey, we'll buy that obligation from you, loanDepot."
and what do they do?
Fargo.
Then they package that up and sell it as a bond, right?
Correct.
Yeah.
Correct.
And then that's where investors come in and they buy the by the by the MBS,
Yeah.
mortgage-backed securities.
But again, my favorite measure is going to be the 10-year Treasury, and that is by far, I think, the better version of it. These days, there's also a thing called the spread. That's the difference between a 10-year Treasury
Whoa,
rate.
whoa, whoa.
Yep.
Hey, this is G rated. Okay. Don't be getting dirty on me. All right.
Okay, I'm not getting dirty, buddy.
Keep
No,
it
the spread
keep it
is the
clean.
difference. The spread is the difference
Oh my
between
God, there you go,
10-year
using that word
Treasury.
again.
Okay. That's the only thing. That's the only word you can use. The spread between a 10-year Treasury and actual mortgage rates these days is higher than it used to be. Okay, so that is because there's more risk involved these days, right? So and what we have is a 10-year Treasury and the 2-year Treasury. There's a difference between those two, and that's also a spread. So the closer the 10 and 2 get
Hey,
together,
stop
hit me.
Stop using that word.
Okay, all right. So anyway, if you wanted to see what the rates are going to be, I would take the 10-year Treasury and I would add a couple percents to it, and that would be.
What about doubling it? I heard that doubling, you take the 10-year treasury yield and you just double it. So right now, where's it at? It's at
3.873 today.
3.87. Well, it won't work, right? That's
No.
That's
almost 7%. I think we're
It's
closer to 6.5 or 6.25 today.
all right.
Yeah.
Okay.
So you
Well,
can
I think
always
it'll
add
work if
2%
it's
to it, and
lower.
you'll be happy.
Was that?
You can add 2.25% to it, and you'll be happy. So you'll find out what mortgage rates are. And what I tell my customers, Louis, is I say mortgages rates are basically butter. You can go to Lucky's and buy butter, and you can go to Save Mart and buy butter, or Safeway. Everyone's going to have a different sale price on it today. So it might be $1.58 at Lucky's. It might be $1.57 at Safeway. Yeah, it's 2 cents more, whatever it is, blah blah blah, or 2 cents less. But they're generally going to be the same, and you're going to find that that's across the board. So if you're rate shopping, you're going to find that most lenders are going to be the same rough bucket of prices for the most of the time, except for jumbo products, which jumbo relies on a whole different market. And banks do mortgages differently with jumbo, and brokers like us, we do mortgages differently with jumbo. So the banks tend to offer slightly lower interest rates if you have money. So if you got $1 million, which I don't know a lot of people that have $1 million in their bank accounts, but if you got $1 million, then you might want to look at one of the banks to give you a slightly better mortgage rate. But you have to fit in a specific box. If you don't fit in this box, it doesn't work at a bank.
Yeah, you got to have that perfect FICO, super vanilla type.
43% debt to income ratio. You can't. You have to be working at a certain place for a certain amount of time. If you're self-employed, I probably won't be able to interpret your income the same way at a bank as I would here. So that's kind of where I think our niche is. We can do things that banks can't. Like, for instance, our jumbo flex, it goes to 55% debt to income ratio. So instead of being 43% debt to income ratio, I can expand somebody's buying power up to 55% debt to income ratio. And that's a huge difference than what banks can do. And again, I think that you have to see where you fit and what products can be kind of tailored to your needs today. Makes sense?
Gotcha. Yep, it does make sense. It does. So rates are down. Life is good. Next month, with the Fed funds rate potentially going down.
But that's the problem too, Louis. As the Fed funds rate goes down, so in Santa Clara County, we have a shortage of homes. There's definitely, I mean, something comes on the market. If it's not sold in a week, it's got a pricing issue. Okay, so there's so many people here that are ready to buy. They've got their pay stubs ready to go, and I'm just ready to buy as soon as it comes on the market. I was at an open house this weekend. The house was listed for 9 days. We had, I think, 15 groups come through on Sunday. And I
Sold.
don't know how many they had on Saturday. Just 15 groups. Is a $2.5 million house, man. $2.5 million. So for
But
that
that's
level,
entry level.
that's entry level. It was really bare bones, man. 3 bedrooms, 2 bathrooms. It wasn't huge. It wasn't a mansion. It didn't have a nice yard or anything like that. It was just a regular run-of-the-mill house. $2.5 million. It's close to Apple. It's close to Nvidia. So it's $2.5 million. But to get that house, you need 20% down. So that's $500,000 right there. Number one, you better have $500,000 sitting on the side. And then on top of that, you're going to be getting a mortgage for $2 million. That's a $16,000 payment roughly every month. So you better be making at least $35,000 a month to make that happen.
Yep. 350. What is that? 500. Well, yeah, 500.
Yep.
Santa Clara County. 2
That's it.
software
Yeah.
engineers, 250.
Yep.
Pretty
And
common.
on top of that, this is a $2.5 million house, like I told you. So you've got Measure E tax on top of that. So you're getting charged a mansion tax. And I'm telling you, this is not a mansion. This is a tract home that was built in the 1970s, and you're going to get
1970s.
charged. You're going to get charged Measure E taxes, which is to help the homeless. So it is what it
Damn.
is. Yeah. But again, we
That's
had
wonderful.
15 groups walk through. So 15 people ready to pull the trigger. And one of these guys came through. He was just mad. He would walk from room to room to room, and he would look at things, measure things. He goes, I don't have time. I got to go. But I want to know, why is the house being sold? Sir, it was an investment property. The guy wants to get out. He's leaving the state. So it was funny. The guy was just on a mission, but he had seen 4 or 5 other houses. So there's a lot of people like that on the market ready to go. But the key here is, as interest rates drop, every percent drop in interest rates is going to bring 5 million more people on the market. So if you look
Right.
nationwide right now, there's something like maybe 1 million houses for sale, 980,000 or something like that. Out of those 980,000 houses that are ready to be sold today, about 60% of them are in contract. So let's just use round numbers. Out of the 1 million houses that are ready for sale today, 600,000 of those guys are already in contract, roughly. Okay, that leaves you with 400,000 houses. And there's 3 million people on the marketplace looking for homes. So 3 million people got to fit in 400,000 houses. This is across the US, of course. All right. Now, drop the interest rates 1%. Now, what do you have? 5 million more people are going to come on the market. So now there's 8 million people hunting down those 400,000 houses that are left on the market. It's insanity. So it's gonna drive prices completely through the roof, I think. So every percent decrease is a big deal for you if you're looking for a home. Yes, it makes it more affordable, okay? But you're going to be paying a lot more, I think, for it, because people are going to be 20 instead of 12 people, 15 people walking through your house, it's going to be 50 people walking through that house.
50. Yeah, like back 2020.
Yep.
2021. No, not 2020. Even 2019, end of 2019. So rates are down, things are nice. What do you think September is going to bring? Because
I think half a point.
Huh?
I think well, dude, so there's something that I recently got introduced to. It's called the September phenomenon. Now, you can also maybe talk about the October surprise, which is that every single election, something happens in October to flip things on its head and make the marketplace weird. So I don't know what's going to happen, but this September phenomenon is actually a cyclical. It happens every September. Mortgage rates increase. Okay,
Why,
interest
right?
bond prices increase instead of decrease, which is wild to me. Okay. So I'm going to dig a little bit deeper into this thing, but look up September phenomenon. And most bond traders will tell you what September phenomenon is when bonds go higher rather than lower. So I think there's 3 things for me. Okay. One is the Fed, what they're going to do. 2 is the elections. And now 3 is going to be the September phenomenon. And again, back to number 1. Number 1A is unemployment. Number 1B is inflation. Is inflation coming down or not? Or
But,
is employment at a good level or not?
and you make a good point, because if the rates do drop, like if they do stay low through September, October, November, what happens to the price of houses, right? What happens to the cost of goods? I mean, they're going to start to go up, and
I
now you
think
have inflation.
you're going to get back to inflationary pressure. But again, this is the election year. So if you look back historically, in every single election year or election cycle, you're going to see an automatic decrease in interest rates, period. It happens every single election cycle, every 4 years and every midterm election cycle. interest rates go down slightly, maybe like an eighth to a quarter, right? But then, or if it's a huge election like this one, maybe more. I have no idea. But then they kick back up in November and December again. Okay, getting ready for the new cycle of the spring season, which hopefully this year will also include some rate cuts in January. That's right, you heard it here first, guys. January, I predict another rate cut. So I think it's going to be a September and a January. And the politics of this is going to be huge this year. It's going to be something to talk about, something to think about here.
Hmm.
What are your thoughts on that?
Well, I think with the September, yeah, you're right. Historically, September has always seen higher rates, regardless of, or irregardless of whatever is happening. So elections, it just doesn't matter. It doesn't really matter if there's election coming up, if there's war, international turmoil, the
I didn't even
rates
talk about
typically
war.
come up.
That's a whole other
Yeah,
topic in
that's
and
a
of
whole
itself.
different
Worldwide
conversation.
conflict, right? And that we are actually married to the world, so everything that happens
Mhm.
around the world affects us as well.
Right, but I mean, unfortunately, international turmoil does help us in a positive way because of the flock to safety. I mean, everybody runs and puts their money in the bond market.
Start
So,
buying Lockheed. Start buying Boeing.
so he is not recommending that.
No,
He is not a financial advisor.
I am not, and I don't play one on
Disclaimer.
TV either.
Whoop, whoop, whoop. Hey, 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 hey. Do
Come
not.
on, man.
uh, anyways, yeah, the September rates, if they go up, which historically they do, it's gonna put a pause on everything. So for
For September,
home
but Lou, I think
for
the Fed's going
September,
to lower the rate at the end of September.
but it's not gonna. I don't think it's gonna have an effect.
It
I don't
won't
think
have the
it's gonna.
effect. I think people are,
No,
whoa, it's going to come down like one. It's not going to do that. It's not going to be magic and overnight happiness and
no,
success. Everybody's getting married, having kids. It's not going to happen.
no.
So
Especially since historically September, every September the rates have gone up. So
yeah,
what's different this time? I mean, it's going to be the same thing. Rates
yeah.
are going to go up, and probably October we might see lower rates. So if you're in the
I
middle
want
of
to hear.
refinancing, or if you're thinking about refinance, you either do it now or you're
Yep,
going to wait and see what happens. So
probably
now's
till
the
at
time.
the end of October. I think the beginning of November, you will see probably a slight decrease again because of election factors. Look, Lou, it's if you look at the New York Manufacturing Index, I forgot what the name of that index was. Anyway, it's at a
English,
negative.
English. I don't know. That's too
So,
complicated for
well,
me.
it's at a negative. That means people aren't producing. Industrial industries or in tech. What do you call it?
So they're
Industrial
not building.
manufacturing. They're
So
not
there's
building.
a report that they're
The
not
economy
building.
is not. They're not building. So if you hear about all this great economy stuff that's going on, if people aren't building things and producing things, and then how can people buy them? And the reason they're not building things
Right.
is because they're not getting orders for these items. Okay, so and another thing that you see,
Eventually it'll
Walmart,
catch up, and that's unemployment, right?
it's unemployment, brother. It's unemployment. So if I don't have the money to go buy things, I'm gonna simply pare back. And before maybe I was shopping at Macy's, now I'm gonna start shopping at Target. Maybe I'm gonna even go lower. I'm gonna shop at Walmart. Walmart has
What's
seen
wrong
an
with
uptick.
Walmart?
Nothing wrong with Walmart, but it's now people are starting to buy groceries at Walmart more often. Okay, even more affluent people are starting to go to the WalMarts of the world and the Targets to do their grocery shopping. Why? Things are more expensive. That's indicative of the health of the economy. I really think that is, and I think that's going to force the Fed's hand more so than I think anything else. And unemployment and the state of the economy, and
But
inflation is just crazy.
but here's the deal, Ramin. I don't understand. Help me understand this. If the Fed funds rates go down and the banks are no longer going to the Fed for this, to get this rate, what what's going to keep them from going somewhere else and getting higher yields, right?
It's riskier. It's riskier, right, Lewis? And this is why we had that small dip
Damn,
earlier. So it was the Japanese yen
damn.
and the carryover cost of holding that Japanese yen. So
Look at that.
I'm an investor. I bought Japanese yen because it was cheap. I'm buying that money, trading into dollars. And I'm going to go buy Nvidia stock and try to make my 10x there. Okay. Then I go back and convert that back to Japanese yen again. Happy days are here again. But if you get caught in the mix, it's called a carryover cost, right? How much does it cost me to convert those yens over? If the yen drops, and that's what happened. That's why we got the rate drop earlier, but it can kick back up. So this is why I'm saying we're tied to the world, and whatever central banks are doing across the rest of the world economies, they're going to also affect us. So this is going to be very volatile. I honestly, Lou, I think this is more like the 70s than anything else, right? We had the W happening, right? So we had inflation. Oh, we're down. No, we're not. Oh, we're down. No, we're not. Oh, we're down. And then the war with Iran happened, the hostage crisis, right? And so this is, I think, where we're at. And we had a great Fed chairman back then who wasn't afraid to raise rates higher. And I think raising rates was probably a smart move right now too. I don't think lowering rates is going to solve our economic problems these days. I think we should have a higher rate environment, rip the Band-Aid off, deal with it, and then come back and live life like we used to.
Fantastic.
That's my
I
three
love
cents.
it. So you know what? Let me summarize all of this, okay?
Yeah.
Or let's summarize it, because really, we don't know.
No.
We don't know what September is going to bring. And anybody that says that, oh yeah, rates are dropping, or oh, rates are going up, they're lying,
No.
or they're
They're
misleading.
wishing. I think it's wishful thinking, Louis.
Yeah. We don't know. This conversation just proves that, yes, we have all the data, we have all the charts, but we don't know what's going to happen. So really, I want to end with this. Well, me, and then you can close it out. But I feel that the best time to buy a house, you want to know when it is?
5 years
Years
ago. That's right.
5 years ago, because it'll even out. Just like Even Steven. Remember when Seinfeld?
That's right.
Seinfeld, Even Steven. Remember that episode?
Yes.
He would lose $20. He would find 20. What the hell? Even Steven. And we lost Ramin. Ramin needs to get either a new computer or better internet service, because he just keeps going in and out. Now, I'm going to have to stay on here until he logs back on so he can log us out. So I'm going to start with some jokes. Yeah. What did, no, I'm just kidding. I'm not going to do that. But again, there he is. So again, I was about to bust out some really cool jokes, like,
well, we got Nandor. I don't know if you remember Nandor, back in FutureWorks. He says he's not going to refinance. His rate is 1%. Nandor, you're sitting on a gold mine, brother. But you know what? You can always
hey,
buy another house.
Hold on. I think he's rounding down. I think it's more like 1.875.
Is you refinancing? Like there you go.
He's all 1%.
And he says he still loves us, which is kind of nice. Thank you, Nandor. We love you too, brother.
Oh my God. So I was going to tell a joke, right?
Hit it.
So a zebra dies and goes to heaven. That I'm going to stop, because
I think that's a good stop. Yeah. Okay. Hey, so I'd love to hear from everybody, please. If you don't mind, in the comments, if you guys hear this later, I'd love to hear your opinion. Are we going to get higher interest rates in September? Are we going to get lower interest rates in September? Are we going to get a cut from the Fed? And if we do get a cut from the Fed, is it going to make a difference because of the September phenomenon? I'll be writing about this on LinkedIn. So follow me. Follow Lewis. His tag's in the bio right here somewhere. Follow. I'd love to see you guys on Instagram as well. So please
just Google Luis Renteria VA loans.
There you go. Bam! And actually, Lewis, we're going to be doing a VA series all the way up to November 11th, right? So every week we're going to be talking about VA only. I want to see Marines. I want to see Army guys. I want to see Air Force dudes. Okay, I want to see space guys. Can we get somebody from the Space Force in here?
I've never seen one. Every time I get close to one of them, they teleport away, because they got this teleporting kind of stuff. So,
crazy. Hey, Lewis, we got another comment here. Can you read that?
They do. John Q, public homeowners out there. But how many rate sheets are already baking? Yeah, they are. They are cutting it. But typically what happens is in September, rates go up regardless. So we don't know. The point of all this is that nobody knows. And
dude, that's our buddy, Joel Ramirez, man. Joel, thanks for coming on, brother. I appreciate that. Oh, yeah. So, yeah, Lewis, this is Joel Ramirez from LA. This is one of our loan partners.
Our home skillets.
That's right. He's good. He's a good guy. So, Joel, thanks for asking. I really don't know. I think it's going to get a lot of John. Yeah, absolutely. It's about attention. It's really about attention. But how many rate sheets are already looking at the upcoming cut? I think they probably are going to go up, to be honest with you, Joel. I really think that rates are not going to go. You remember we had that kick down about a week ago? We were down at 5.87, 5.6. somewhere in there, and we're back up to 6.1, 6.2. So again, I think if you're at $1 million mortgage, yeah, that makes a difference. Okay. But if you're at a $300,000 mortgage, $400,000 mortgage, that's 0.125. Man, just rest on it for a second and then see what you can do with it in 6 months, right?
Yep. Get into your home.
Yeah, I'm not a day trader, and I think I can go crazy being a day trader, right? So watching markets go up and down, yeah, you may be trying to make that trade, but even when I bought my house, Lewis, in 2008, I waited. I floated the rate and trying to get a better rate. And by the time I locked, I was at 0.125, right? So it didn't kill me. It was only a $400,000 loan, but it was $25 or something like that, whatever it is. But it is what it is. So I don't think timing the market is really going to work. Buy now, and you should have bought a long time ago. And if you were
5 years ago,
loan like Nandor is at 1%, 1.8, whatever it is, I think
it's 1.875. I gotta challenge that 1%.
I want to see a statement.
I don't think I've ever seen a coupon go down to 1%.
I've seen a 1%, Lewis. I've seen a 1% for that bank online, ING.
Oh dang!
Yeah, I have seen 1% loan. Yeah. That'd be great to have one of those. Yeah. Hey, thanks a lot for coming on, guys. Joel, I want to hear more from you, buddy. All right, good to see you. Again, we're going to be doing a veteran special. Also on Wednesday, we're doing a 1031, guys. So kick on Wednesday. I think it's going to be at 12:15 on that one. We're doing 1031, all things 1031 related. So it's going to be great.
And then we got tomorrow, 2:30 Pacific Standard Time.
That's right. What's the topic, Lewis?
I don't know. Oh, we're going back to NAR. We're going back to NAR stuff.
Right.
So NAR, and I want to sprinkle in a little VA stuff in there because.
Okay. All right. So tomorrow is NAR. Wednesday is 1031. Next week is going to be awesome and special. I'm going to bring you guys a segmented tax analyst. So segmented cost, what do you call it? Segmented cost analysis. Yeah, that's when you take your curtains, your paint, your flooring, and you depreciate that. All right. So it's good stuff, especially for your investors out there. Thanks a lot, guys. Appreciate it. Hit me up in the comments. Love to hear from you guys. All right.
Peace out.
Can I get an outro?
Yo. His palms are sweaty, knees weak, arms are heavy. There's vomit on his sweater already.